To discuss, I'm joined by Warwick Lucas from Galileo Capital. Thank you for being with us,
My
Warwick.
pleasure.
So explain how all this red behind us seems to be linked to the rate hike looming in the United States.
Okay, well, I think a lot of the strength that we saw post-Trump was expectations of some inflation that would then feed into the U.S. economy and drive growth. Obviously, inflation has its own consequences, but that was what all the excitement around particularly U.S. stocks was all about. So the indication that the Fed is going to come in, apply brakes somewhat, obviously then coming in to dampen that enthusiasm. And I mean, that could tighten the market for dollars generally. So yeah, there are definitely some consequences. As far as South Africa goes, well, we've moved away from the situation where SABC said, well, we'll look at the US rate cycle. If they hike, we'll hike. I think we're off that kind of pattern, but nevertheless, they will take cognizance of it. And if they do hike, it might lengthen out our own rate cutting cycle.
So it sounds like two effects. So one will be not the global growth that we're expecting, basically, which affects us as an emerging market. We want to be tied into those big markets growing at a faster pace.
Yeah, very much so. Look, I think as far as commodities go, I mean, it may tend to rein those in, but commodities go through much longer cycles. So it may sort of constrain it rather than just put the brakes right on. So I guess as South Africa goes, we'll smooth our way through this one.
And there's always been a fear that when those rate hikes come, we saw the first one, then nothing for a long time, but there was a big fear that there would be an exodus out of emerging markets, that our rand would drop, the dollar would increase. Is everything priced in now, or could we still see an effect? Because we're talking about a hike as early as mid-March now.
I think there's still, certainly on the US side, a bit of pricing in to come. I guess there's been fairly firm communication to the effect of 3 rate hikes expected within the year ahead. I mean, the Fed has had no illusions that the policies put forward by Trump and that he's trying to now obviously execute through Congress and so on, definitely have an inflationary bias. So from their part, I think they're quite clear about signaling that they will be on watch for inflation.
All right, so a lot of this now, caution, because Janet Yellen is going to speak, and that may or may not clarify this matter. What do markets want to hear today, or what are they expecting?
I think it's really a case of this is the first time that we're really going to sort of see how the Fed relates up to the Trump administration. So I wouldn't say necessarily some kind of detente or standoff, but the Fed is now going to be very clearly positioning itself in a revised monetary environment. And I think some trepidation ahead of that. I guess a case of really just looking to understand what she's going to do. I think the main thing is that with the amount of liquidity that the Fed's created in the last few years, what the markets, and particularly bond markets, don't want to see is a massive and aggressive expansion in monetary supply as a result of the banks starting lending again, because that is the kind of thing that can trigger runaway inflation.
All right, so let's see what she says later. I guess this is quite a strong pullback, because we've seen incredible market performance over the last few weeks. I guess what's happening in China isn't helping. They're concerned about South Korea.
Look, I think that in some ways is almost a diplomatic scrap by proxy. The South China Sea has got an endless array of potential diplomatic scraps in it. It's as ongoing as the Cyprus question. It's one of those that'll always be there, and hopefully never turns into something worse, because that certainly would be disastrous if that went into full-out war. But I mean, it's just one of those things. It's a scratchy part of the world.
All right, finally, let's look at two stocks that were interesting yesterday. One was MTN, which closed 8% up, 10% up at one point. But looking behind you, that's pulled back. Is that just part of the general market pullback?
I guess it's partially general market pullback. Look, as far as the markets that MTN are in, it's particularly in emerging markets more than most. Nigeria, Iran, etc., etc. So those being very sort of, shall we say, at the fringe of the global sort of borrowing environment, obviously the potential sensitivity to a stronger US dollar and effective quantitative tightening that entails, obviously there's going to be a higher magnifying effect. I mean, as far as the turnaround that MTN's putting through, well, it looks like solid stuff. So I'd put this down to trade rather than fundamentals.
All right, so down more than 4% at the moment. And finally, Standard Bank making headlines because they were among the banks fingered by the Competition Commission. They're now saying they don't know what the rogue forex trading that the Competition Commission is talking about is. Are investors watching that closely?
Look, it's certainly untidy, but from what I can see, the whole forex debacle looks to me like a personal enrichment scheme. I don't think that is illustrative of anti-competitive behavior, and it's unfortunate really that the investigation's gone this way, because it now forces the banks to defend themselves as corporate entities, when in fact I think the fallout should have been that individual concern should have been pursued intensely, rather than the corporates.
Yeah, some individuals named, but they're all saying there's only a few in each of these banks. Thank you so much for your analysis.